Thank you very much for joining the Central Bank of Malta webinar. We've been trying to continue with our activities in spite of COVID, and this is actually a wonderful way to do it. We have a very well-talented expert guest with us today, and I'll allow our Deputy Governor, Sandro De Marco, to make the introduction. Mr. De Marco, over to you.
Thank you.
Yes, perhaps I can just get rid of some of the housekeeping. This meeting is being recorded. If people don't want their cameras to be on, by all means, leave them off. It will be recorded, and the intention is to put it up onto our website afterwards for those who are not able to attend. We will also be asking you please to mute your microphones. We will be having a question and answer session after Mr. Napolitano's presentation. So as we go through, if you'd like to raise your hands, I will be taking as many of the questions possible in the time that we have allotted to us. So at the moment, I think that's all I have to say from the housekeeping. Mr. De Marco, over to you.
Thank you, Vanessa. Well, first of all, good morning to everybody, and thank you for joining us in this webinar, which will be dealing about the impact of the pandemic on European sovereign ratings, Fitch ratings approach. And I would like to firstly welcome and thank Mr. Napolitano, who kindly accepted to deliver this talk today. Mr. Napolitano started his career as a corporate researcher at Business Malta International and then moved for a year to Global Insight as an economic data analyst, after which he worked for 3 years as senior economist at the Economist Intelligence Unit on macroeconomic forecasting and modeling, as well as country risk analysis. He then joined Fitch in January 2010 as an economic advisor in the Department for Business Innovation and Skills, but a year later he became associate director covering Central and Eastern European sovereigns, and later in 2013 he covered Western European sovereigns, including Malta. In March 2015, he moved for almost 2 years to Barclays Investment Bank, occupying the role of Vice President for Macroeconomics and Credit Analytics. And since the end of 2016, he went back to Fitch as Senior Director and Head of Western European Sovereigns, a post which he still currently occupies today. Michele has a BSc in International Economics from the University of Trieste and an MSc in Economics from Birkbeck College, University of London. Today, Michele will be talking to us about the impact of the pandemic on European sovereign ratings. This is indeed a very interesting and most relevant topic in the times we are living. I have to say that it is also most relevant for central banks because credit rating agencies play an important role in monetary policy operations. Counterparties, namely banks, requesting access to monetary policy operations are required to place collateral with central banks, and both eligibility as well as valuations of such collateral will very much depend on the ratings provided by credit rating agencies for those assets pledged as collateral. Not to mention, of course, also the asset purchase program, where eligibility also depends on ratings by such agencies. One of the many challenges that a deep crisis like the one experienced in 2008, 2009, and the current crisis, of course, is that credit ratings tend to be by their very nature procyclical, meaning that downgrades occur in crisis and upgrades happen in good times. Hence, during a crisis, which is usually the time when banks need most recourse to monetary policy operations for liquidity provision, the value of their collateral falls because during crisis CRAs, credit rating agencies, tend to downgrade the credit status of sovereigns and corporates. Through rating migration, financial assets could also lose their eligibility status, thus compounding the difficulties for banks to access liquidity. Movements in credit ratings also impact credit spreads across different classes of assets and issuers, which in turn could create heterogeneous impacts across different parts of the euro area, for example, making it more challenging, in our case, for monetary policy responses to shocks that may have heterogeneous effects, even if the shock is common to all member states, as is the case of the current pandemic. However, I will not take more of your time, and it is best that we hear what Michele has to tell us about today's topic. The floor is yours, Michele, and thank you.
Okay, thanks a lot. Thank you, Mr. DeMarco. So first of all, thank you for the invite. It is really a pleasure and an honor to be asked to hold this seminar for the Central Bank of Malta. I'm only very sorry that we can't see each other in person. I can assure you I would very much prefer to be in La Valletta. But I hope we'll have the chance to see each other at some point in Malta. So let me share I've prepared a few slides for today's presentation. So let me share the slides with you now. And okay, hopefully you can all see the slides. If
yes,
not,
perfect. Yeah,
okay.
it's fine.
Okay, perfect. So,
sorry, could you make
yes.
it's Dennis here, could you make it full screen maybe? Okay, thank you.
It should be full screen. I think there is a bit of a delay.
Yes, it is.
Yeah, there is a bit of a delay, but hopefully, yeah, you should all see full screen. So as Mr. DeMarco was saying earlier, what I want to talk to you about today is how we at Fitch have approached the sovereign ratings in Western Europe in the face of this global pandemic crisis. As I will say later, I mean, Mr. DeMarco pointed to a very important issue, the fact that rating actions can be pro-cyclical. Hopefully I will convince you that this time around we've been trying as a rating agency to avoid that. I will talk about that a bit later on. So my presentation is really divided in three parts. I want to start by giving you an overview of our latest macroeconomic forecasts. At Fitch, some of you may know, others not. We have an economics team that works beside the sovereign ratings team. I am part of the ratings team. I am a sovereign credit analyst, but we also have an economics team, a team of economists that is responsible for our macroeconomic forecast. And just last week, on the 7th of September, we have published our new global economic outlook. So the first part of the presentation will be a fairly brief overview of our latest macro forecast. Clearly, that's very important because it feeds into the sovereign rating analysis. So in the second part of the presentation, I want to discuss what are the implications of the macro backdrop of our macro forecast for sovereign ratings in my region, the Western European region. And I will conclude the presentation by talking specifically about the Fitch view on a few specific European countries, and I will say also a few words on Malta. So let me start. This first slide is really a snapshot of the global macro picture. We think at Fitch that world GDP growth declined significantly by 9% year on year in the second quarter of this year. This is clearly a devastating shock to the global economy, outside the range of anything any of us would have been forecasting before this pandemic. But there has been significant divergence, significant variation across countries, as you can see in this slide. So on the left-hand side of this slide, you can see the countries that have been most negatively affected so far in terms of GDP growth. There is India, the worst affected, but in Europe, Spain, UK, France, Italy, all experienced very sharp declines in GDP growth between the second quarter of 2019 and the second quarter of 2020. Now, in our view, the severity of the recession is partly correlated with the level of stringency of the lockdowns, but also the length of the lockdown phases. In our view, so far, evidence suggests that the duration of the lockdowns matters as much as the stringency. That is definitely the case here. I'm talking from London as we speak, and here in the UK, the lockdown was somewhat less stringent than in Italy or Spain, for example, but it lasted longer, and the second quarter GDP figure was one of the worst, as you can see from this chart. But the main message of this slide is there has been virtually no escape from the economic crisis related to this pandemic. The fact that the pandemic hit so many countries so quickly, simultaneously, clearly mean that we had many spillovers operating through trade and financial linkages as well. So the end result was that even countries where the epidemiological, the healthcare situation was fairly under control, or at least not as severe as in other countries, Germany or South Korea, even those countries suffered very heavy declines. So a pretty devastating shock that the world economy has just been through. However, one piece of relative good news, if we can talk about good news in this period, is that although the depth of the recession is really enormous, it has also been a very short one. So the abrupt interruptions to activity in March and April were followed by sharp recoveries as restrictions were eased. And this is evident from a large batch of data, official monthly measures of GDP in UK and Canada, as I'm showing on the left-hand side chart of this slide. All these indicators show that activity really was rising quite quickly in May and June after very sharp declines through March in April. I don't want to give too many numbers today in this presentation, but I think there are a few numbers that I want to draw your attention to now that are useful. US GDP, for example, was minus 14.5% below its January level at the April trough, but by June this shortfall has been reduced to minus 5.5%. And with different magnitude, this picture is similar for Canada and the UK as well. For the Eurozone, monthly GDP estimates, as you know, are not available, but a wide set of other indicators confirm a similar pattern of a very deep two-month recession, followed by sharp increases in activity in May and June. On the right-hand side, here I show retail sales volume, and that is back to pre-pandemic levels in UK, Spain, and France, for example. So what does this all mean for our forecast, for our economics team forecast? As I said, new forecast just published last week, 7th of September. We now expect world GDP to fall by 4.4% in 2020 as a whole. This would be more than twice as deep as the Great Recession in 2009. But is less severe than the decline we were expecting in our June global economic outlook. So this represents the first upgrade to our 2020 global GDP forecast this year. I don't want to go through the numbers. Maybe I'll just say a word on the two things, a word on the Eurozone. For the Eurozone, we actually expect a contraction of 9%, and this is a downward revision relative to June. In June, we were expecting an 8% contraction. That's really down to the second quarter outturn that was much worse than expected in most countries, worse than expected by us. But the overall impact on annual GDP forecast has been partly offset by improved recovery prospects for the third quarter of 2020. So to give some numbers, we expect Spain contraction of 13.2%, significant downward revision from our June global economic outlook forecast. We were expecting 9.6 contraction back in June, contraction of 10.5 in France, 10 in Italy. UK GDP is now expected, so outside the Eurozone, expected to decline by 11.5% this year. The second message is that China is one of the countries, so going outside the Eurozone, is one of the countries where we have upgraded our forecast for 2020. We now expect growth of 2.7%. We had 1.2 earlier. Why I mentioned China? Because we think that China shows that if the epidemiological situation is under control, or if there are systems in place to control outbreaks and isolate them fairly swiftly, the impact on economic activity, the recovery in economic activity can be swifter. So clearly, time will tell if what's happening in China will be replicated in other parts of the world. Just a word on 2020-21. We have revised up our world growth forecast for 2020-21. So we expect 5.2% growth, and this reflects stronger growth in the Eurozone. So we have revised upward our 2021 forecast for the Eurozone. But this is primarily a reflection of the lower starting level of GDP from 2020, so base effect mainly. So let me go to the next slide. If the current recoveries, the current pace of recovery in the US and Europe were to continue at the current pace, we would probably see the much debated V-shaped recovery. So we would see a mirror of what has been seen in China. However, we at Fitch think that this is a bit too optimistic, and instead we see the recovery slowing down from the fourth quarter of 2020 as the initial boost from the reopening, from the easing of restriction fades. Why is that? The virus is not contained yet, as we can, we all read the news every day, and the epidemiological data across Europe and also outside Europe, and clearly signs is that the virus is not contained yet, and also social distancing behavior is likely to persist through 2020-21. Consumers are also likely to remain cautious in light of the sharp rise in unemployment that has already happened in the US and that we expect to unfold in Europe later this year and the next year. So let me go a bit more in detail here. Just want to draw your attention. We call this recovery, this is a term of our chief economist. So not my choice, but our chief economist has called this recovery a swoosh-shaped recovery. So only a very slow haul back to pre-virus GDP levels. So moving back to pre-virus GDP levels will take a very long time. In the US, we expect activity to go back to pre-virus level by the end of next year, in the Eurozone by the end of 2022, according to our latest forecasts. So why are we fairly pessimistic on the pace of the recovery? It is really about the headwinds to domestic demand that we see going forward. On the corporate side, we think businesses are going to reduce capex quite aggressively, and on the consumer side, as I said, we think consumers will be very cautious. There was a huge shock to the labor market. This is what I show in this slide here. It has already been reflected in the unemployment rate in North America. It has not been reflected yet in Europe, but we think unemployment rate is going to rise sharply as the massive job subsidy schemes will be gradually phased out. As the job subsidy schemes are unwound and the labor-intensive sectors like the tourism sector continue to struggle, we expect consumers to be cautious and savings rate to remain at high levels and decline only very slowly from the current highs. Another factor that is going to affect the recovery, in our view, the pace of the recovery, is the ongoing direct headwinds from social distancing and restrictions on consumer behavior. In this slide, I show the recent economic developments through the lens of the industrial structure of the economy, the industrial breakdown of individual economies. what we can see on the left-hand side, this is UK data, and you can see that in the UK, all sectors were very badly hit. They suffered a dramatic hit in March and April, and that's obviously a common picture across most of the world. But from May, manufacturing, construction, and retail recovered strongly. The sector where the recovery is still lagging is leisure and transport. So catering, tourism, transportation, entertainment, sporting events, etc. And on the right-hand side chart, I show that this sector is important. It accounts for between 8 and 10% of GDP in some of the major world economies. In Spain, above 10% of GDP. So the weakness of this sector is a direct drag on economic activity and the big driver of our forecast path. Now, this weakness in demand is going to be offset partly by an unprecedented level of fiscal policy support, which will undoubtedly support growth down the line. Here, a very important point, I must stress that our Eurozone forecasts are not factoring in the European Recovery Fund yet, the Next Generation EU. We expect to factor this in at our next round of forecasts. The reason why it's not factored in yet is that we think it is quite hard at this stage to make a meaningful forecast before we have full visibility on the recovery and resilience plans. But obviously, including Next Generation EU might change quite significantly forecasts from 2020-22 onwards. And then we'll also have to make an important assessment together with our economics team on whether the growth impact generating from Next Generation EU is more of a structural nature or a cyclical nature. But that's something that, we'll have to make an assessment on later on. I will come back to Next Generation EU when we discuss the outlook for ratings in Europe in the second part of the presentation. Just one word talking about policy support, one word on central bank responses, just a couple of messages here. Number one, central bank response has been significant, massive liquidity support in March and April. It has had a profound effect on the economy and on financial markets. Government bonds have declined across the board. There has been a recovery in risk appetite, and also credit to the private sector has picked up, something very unusual traditionally in this phase of the cycle. And the other important message from us is that we expect central banks to do more if the recovery weakens and if the inflation outlook doesn't improve. So we factor in our assessment, we expect central banks to do more if needed. However, having said that, the pace of the recovery over the coming months is likely to depend more on science and nature, and the recent surge in cases across many countries poses a significant risk to the recovery. Once again, good news, although it's difficult to talk about good news in this period, is that despite the resurgence in virus cases across most countries around the world and in Europe also, we have not seen significant declines in mobility levels, and that is important for economic activity. This is partly due to the different healthcare response from the authorities this time around. We have not seen national lockdowns yet. We have not seen large-scale lockdowns. We are seeing a more targeted approach by the authorities, an approach that relies more heavily on test and tracing systems. But as analysts, we can't really rule out that there will not be other national lockdowns. As you all know, there are concerns that wintertime might bring an even heavier resurgence in the virus. So we are not doctors, we are not epidemiologists, but what we can say is that this is a downside risk. The extent of the virus resurgence and the authorities' response are a big risk to our projections. So I want to turn now to the second part of the presentation, and I want to focus on Europe. So everything I've said so far, I've really set the stage, the global macro backdrop. What does this all mean for Western European sovereign ratings? This is what I'll try to explain in the second part of this my presentation. Let me start by explaining first what has happened to our ratings in Western Europe so far this year. The backdrop, in a nutshell, a growth shock and the fiscal shock. Western Europe is facing a growth shock, and then it is facing a fiscal shock that is induced by the fiscal response put in place to deal with the growth shock. The rating actions taken so far reflect this backdrop. Fitch has taken negative rating action on 11 countries in Western Europe since March. 3 countries which entered the pandemic crisis already on a negative outlook were downgraded: Italy, the United Kingdom, and San Marino. 3 countries previously on a stable outlook have been placed on a negative outlook: Belgium, France, and Iceland. And we revised 5 sovereigns previously on positive outlook to a stable outlook. We affirmed their ratings, but we revised the outlook from positive to stable. These countries are Malta, Austria, Cyprus, Greece, and Portugal. Now I want to spend quite a few minutes talking about our approach. So hopefully, probably the thing you are most interested in. So what has guided our rating decisions, the rating approach we have taken, and the rating approach we want to take going forward. So the first point I would like to stress is that despite the sharp deterioration in public finance metrics across the board, the sharp deterioration in the growth outlook, we have not taken negative actions across the board, and we want to continue to do this. We have adopted a framework that we believe it helps us differentiating across countries. We look at a number of factors, and the most important one is the track record of each individual country. Track record matters. This is what I wrote down in this slide. The past track record of GDP growth. This is very important. More specifically, the track record of post-crisis recovery for individual countries. Why the track record of GDP growth is important? Because we think that countries that have more flexible and diversified economies, or that have implemented reforms in the past, should be in a stronger position to recover post-pandemic. Second, the fiscal track record. We ask ourselves what is the sovereign record of fiscal discipline, fiscal consolidation, fiscal prudency during more favorable economic times. Why we think the track record is important? The track record of growth and fiscal discipline is reflected in different starting points with regards to the level of public debt. In our view, countries that have entered this crisis with public debt to GDP on a firm downward path have more rating headroom than others where public debt has not peaked yet. So let me now talk about the future. So what are going to be the key themes for Western European sovereign ratings going forward? Fiscal trajectory, very important. So how countries will approach their 2020-21 budget will be a key factor to watch for us. Let me just assure you that we are not naive. We do not expect significant fiscal consolidation across countries. We do not expect significant fiscal consolidation measures being announced in the next budget or kicking off even next year. But plans that give at least a roadmap on how to contain the growth of public debt to GDP and place it on a downward path over time, that is something that we would attach quite a lot of importance to as a rating agency. And this will be particularly important in European Union countries. As you know, the Stability and Growth Pact rules are suspended this year and next, so there is no explicit fiscal anchor in the EU. How countries will approach their 2020-21 budgets in the absence of an explicit fiscal anchor will be a factor to watch for us. One word on the fiscal rules per se. From our discussions with ministries of finance around Europe, with central banks as well, with politicians, we believe that there is consensus on the fact that the fiscal rules as they are have become too complex and less predictable. So we believe there is some consensus on the need to make these rules simpler. Now, many of you may not know that rating agencies cannot give policy advice. We do not give policy advice to governments. So we will never give policy advice on how the fiscal rules should change or not. But we would agree that the EU fiscal rules are suboptimal. They have become very complex. The complexity of the rules and the lack of transparency mean that it is very hard to assess compliance of the rules in real time. Sorry, can you hear me?
We're hearing an echo.
Yeah, I hear an echo as well.
Somebody should switch off his microphone. I don't know, maybe that helps.
Okay, yeah, I think that was solved, sorry. Okay, sorry for the interruption, but just wanted to make sure everything was fine. So I was just saying that very hard to assess compliance in real time, rules that are based on unobservable variables, the structural fiscal balances that are dependent on very variable estimates of potential output that are very difficult to make, and output gaps as well. So if this suspension of the rules, this period of suspension, was to lead to a consensus on a new set of fiscal rules, possibly based on observable variables and a less complex set of fiscal rules, that could be a positive spillover from the crisis. But we know that it will not be easy to reach consensus among member states on the details, among member states and also the European Commission on the details of a new set of fiscal rules. Now, another key theme will be clearly the growth trajectory as well. This is another key theme for sovereign ratings that will affect sovereign ratings in Western Europe. And one important factor in particular will be how governments will phase out the employment support schemes. There are some trade-offs here. Renewing these programs protect employment, potentially protect consumption patterns, but also have very large one-off fiscal costs. On the other hand, removing these programs too soon could result in a spike in unemployment rates, potential significant increases in spending for unemployment benefits, automatic stabilizers, maybe for a longer period of time. So no easy choices for governments here, but how these choices are made will be an important factor in our rating assessment. Next Generation EU, the European Recovery Fund, will be a very important theme, a very relevant theme for Western European ratings over the coming years. As you all know, Next Generation EU effectively mutualizes part of the cost of the coronavirus response at the EU level. It will introduce some fiscal risk sharing and also central debt issuance, and it also opens the door to some central tax collection. So let me just tell you what in previous years we said about similar initiatives. In previous years, we said that centralization at the Eurozone level of some fiscal revenues to enable an element of counter-cyclical transfers, would help countries coping with shocks, while at the same time maintaining a certain degree of fiscal discipline, maintaining compliance with the fiscal rules. We also said that such initiatives could have a beneficial impact on ratings of lower rated sovereigns over time. Next Generation EU goes in this direction and can therefore be supportive of ratings. In particular, we would view Next Generation EU as a net supportive factor for the main beneficiary countries in Southern and Eastern Europe. The extent of any rating implication is hard to gauge at this stage, but is likely to depend on a number of factors. The first is the impact on the public finances. The grant portion relative to GDP is very substantial in some countries, and the important feature from a public finance standpoint is that this grant portion will not form part of the direct debt stock of recipients. Countries will receive these funds in the short term, will repay them over a very long time period. If the funds are well directed, this can provide a substantial short-term boost for the net recipient countries with a fairly limited public finance impact in the short term. And this leads me to the next point. There is a another important rating factor that we'll have to consider in the assessment of Next Generation EU, how the funds will be spent and their effectiveness at promoting a broad-based recovery over time. Now, finally, let me say that the Next Generation EU is indeed a significant step towards more EU and Eurozone integration. But the political battle that preceded the agreement is a reminder that there are still very divergent views across member states, across electorates, on what the appropriate degree of fiscal risk-sharing is. And in this respect, I would like to underline that the disbursement of the funds will be conditional on the projects that individual member states will present. Now, why is this important from our perspective as a rating agencies? From our perspective, how the politics of Next Generation EU will play out is important. Will conditionality create tensions in some of the net recipient countries like Italy or Spain? Will the net contributor countries scrutinize heavily the projects submitted by the net recipient countries? These are factors to watch, factors that can affect confidence in the whole framework. We have said publicly in some of our comments that we think that Next Generation EU could become a more permanent feature, or at least the framework behind Next Generation EU could become a more permanent feature of the EU institutional setup. This would bolster the architectural underpinnings of the Eurozone. But this will clearly depend on how the framework will work in practice and also on the political perceptions that this will create in individual countries. So let me move now to the third and last part of my presentation. Here I just want to give you a snapshot on a few countries. I want to start with Italy. I've chosen Italy because it's one of the high-profile downgrades of this year. We downgraded the Italian rating in April to BBB-, and we placed the outlook on stable. The next review is on the 4th of December 2020. So some of you, I mean, didn't want to give with this presentation a full description of our rating methodology, but some of you may know that I've been talking a lot about public finances so far, but rating agencies do not look only at public finances. I mean, we look at a wider number of factors. At Fitch, we call them the 4 pillars: structural features, GDP growth per capita, governance indicators, the default record, and also public finances, macroeconomic prospects, and external finances. Now, when you look at these 4 pillars as a whole, you can argue that the Italian rating at BBB- is quite a low rating. Why is that? Because under the structural pillar, Italy tends to score much better, much higher than countries in the BBB category. It is a richer country. GDP per capita is much higher than BBB peers. Governance indicators are stronger. And these are factors that, in our view, according to our methodology, increase the tolerance for higher level of public debt. So the outlook is stable. We did downgrade Italy. The main factor behind the downgrade was really the shock. Over the years, we highlighted the fact that Italy didn't grow. Growth is an issue in Italy, and that was the main factor behind the weak public debt dynamics over the years. And very high levels of public debt reduced the capacity to absorb external shock. The country was hit by a huge shock, and the rating committee decided to downgrade the rating to BBB-, but the outlook is unstable, which means that there are no significant imminent pressure on the rating. Now, the main message from this slide, there are really two main things on this slide, growth and politics. The main message from the left-hand side is that weak GDP growth is not really a new issue for Italy. Italy has been growing well below Eurozone average for a long time. And one factor to watch for us going forward is how the pace of Italian growth will be post-pandemic. Without some improvement in growth outturns relative to the last decade, there is a tangible risk that public debt to GDP ratio will continue to rise over time. So this is why we believe that implementing a credible economic growth and fiscal strategy that improves confidence that the general government debt to GDP ratio will be placed on a downward path is important for the rating. And it's actually an explicit rating sensitivity for a positive action on the Italian rating. In this respect, how the next generation EU funds are used will be an important consideration in our rating assessment for Italy. In addition, we obviously follow very closely Italian politics, and we follow all the initiatives that have happened in Italian politics related to the economy. For example, the Stati Generali, the national debate on economic policy post-pandemic, and also the reform plan devised by Mr. Vittorio Colao. It will be important to see if some of these initiatives translate into political action and legislation. On the right-hand side of this slide, I show you a snapshot of the most recent polls. The message is that the political picture in Italy remains very fragmented. There is no clear political boost yet for the Partito Democratico and the Five-Star Movement, the Movimento 5 Stelle, from being in government together and from the agreement on Next Generation EU. But we think both parties have a very strong incentive to stay together and preside over the implementation of projects funded by Next Generation EU, and try and get some political boost from this ahead of the next elections. We also think they have a strong incentive to stay together to propose the next candidate for the presidency of the Republic in 2022. But coming to the economics, the two parties continue to struggle in putting together a coherent policy agenda. At this stage, it remains quite unclear what type of economic policies the government will adopt to support the recovery, and that is relevant from our perspective. Just a final word on the politics. I said basically that we expect Five-Star Movement and Partito Democratico to stay together. So under our baseline, we do not expect this government to fall anytime soon, but a political accident cannot be ruled out entirely. There are important local elections this month in Italy, and a landslide victory for the center-right parties led by Matteo Salvini and Giorgia Meloni could potentially destabilize the government. But in our baseline, we expect this government to remain in place. A few words on Spain. Why Spain? It's because we often get questions from investors on why we affirm the Spain rating and maintain the stable outlook. Spain is a country that entered this pandemic crisis on a stable outlook, and we maintain rating and an outlook. So why we did that? The main reason is the track record, going back to what I said earlier. Unlike Italy, for example, Spain has recorded robust growth prior to the pandemic crisis. And in our view, this is our assessment, such robust growth was not the result of pure luck, but it was the result of structural reforms that Spain adopted during the Eurozone crisis, in particular, labor market and banking sector. These factors, in our view, create some rating headroom for Spain at the A- level. Having said that, while the growth track record was strong, the record of fiscal consolidation was less impressive. Spain, for example, never ran sizable general government primary surpluses, unlike Portugal. As a result, the stock of public debt declined, yes, since 2014, but only very, very gradually. And this is what I show on the left-hand side chart of this slide. On the right-hand side chart, I'm giving you a snapshot of hotel overnight stays in Spain up to July. So this is before August. And yeah, this is quite a sad chart, probably similar across a number of countries, but it shows how difficult the tourist season is likely to be for Spain. As I said earlier, we have revised the Spanish growth very significantly for 2020. At our next review, we will have to factor in a sharper reduction in GDP growth relative to what we were expecting in in June. Going beyond 2021, according to our latest forecast, the level of real GDP in Spain in the fourth quarter of 2020-22 will be around 3% below end 2019. So quite a significant shock to the Spanish economy. But the Next Generation EU has the potential to offset part of this loss. How the funds will be deployed and whether they will lead to sustained improvement in growth over time is something that will have an impact on our assessment. One word on the United Kingdom. Let me move to the next slide. Another high-profile downgrade this year. We downgraded the UK rating to AA- in March, maintained the negative outlook. The next review is soon, the 25th of September, so I can't really say too much today about the rating. But since the downgrade last month, we have revised down our forecast for UK growth and revised accordingly the fiscal numbers as well. The main news is that in our latest global economic outlook, we have changed our assumption regarding the EU-UK trading relationship. So we now assume that UK-EU trade will revert to World Trade Organization terms on the 1st of January 2020-21. This is what I show in this slide. Clearly, this will see the imposition of tariffs and non-tariff barriers on UK-EU goods trade and is likely to involve disruptions at the border. In addition to the trade shock, we see lower investment and consumption and the weaker exchange rate and higher inflation. There are obviously huge uncertainties as to exactly how this will play out, but our GDP forecast for 2020-21 for the UK has been reduced by around 2 percentage points relative to a smooth free trade agreement transition. And we effectively see the UK economy stalling in the first half of the next year. So we expect, just to give numbers, contraction of 11.5% this year, growth of 4% next year. It would have been 6% under a different scenario where a free trade agreement is agreed. Now, the negative outlook on the UK reflects really two aspects, two factors. Number one, our view that reversing the deterioration in the public finances and the fiscal metrics beyond this year will not be a political priority for the UK government. And also the uncertainty around the future trade relationship with the EU. We said back in March, this could constrain the strength of the post-crisis economic recovery. So let me just take these two aspects in succession. On the fiscal risks, our forecasts at the moment do not factor in any additional discretionary fiscal stimulus measures beyond this year. So based on this assumption, we expect the deficit to come down quite a bit next year. This is quite a strong assumption, however, and in this respect, I want to draw your attention to the right-hand side chart of this slide. The opinion polls in the UK are changing. The Conservative Party is losing ground in the polls quite fast. Now, we do not expect the Boris Johnson government to fall, and the next general election is scheduled for 2020-24. But this trend in the polls can affect fiscal decisions in the next budget quite significantly. And the October budget will be therefore an important event for us to watch. So let me turn now to the Brexit uncertainty aspect, how this change in the growth baseline affect the UK, our view on the UK rating. There is one direct implication. The weaker GDP numbers that we have now will have an impact on our fiscal numbers, and we are updating the fiscal figures as we speak. But there is also one important aspect that we have to consider. We need to answer a question as far as possible, or at least to make an assumption. Are the UK and the EU going to trade on WTO terms for many years to come, or will this change at some point down the line, sooner than a few years down the line? In our global economic outlook narrative, we clarified that the fact that the two sides do not strike a deal by December does not preclude the possibility of progress towards a free trade agreement later on. Now, obviously, this assumption, this narrative is challenged by the recent development in UK domestic politics, in particular the decision to present the internal market bill, which overrides parts of the withdrawal agreement. If this bill was to pass through Parliament as it is, it would not go down well in the EU. In EU capitals. So it could make restarting negotiations on a free trade agreement harder, and it could clearly challenge the narrative in our global economic outlook. So I just want to conclude now with a few words on Malta. First, the rating, it's A+, stable outlook. The Maltese rating was on an upward trajectory pre-pandemic. We upgraded Malta. I don't recall the year now, but it was a couple of years ago, from A to single A plus. And last year we placed the outlook on positive. So prior to the pandemic, Malta was A+ on positive outlook. In April, we revised the outlook to stable. The outlook revision reflected the significant impact of the pandemic on the economy and the public finances. As I said earlier, Malta was not the only country which saw its outlook revised from positive to stable. We took similar actions on all countries that were on a positive outlook. So main messages from this slide: clearly economic shock. Malta will experience a sharp contraction this year, but is expected to perform significantly better than other Eurozone countries. The resurgence in coronavirus cases in Malta and renewed travel restrictions could weaken the recovery. But the metrics, if we compare them to other Eurozone countries, as I said, look quite benign. Even the unemployment rate, we expect a sharp increase, but it will remain the lowest in the Eurozone, according to our own projections. Next Generation EU, we expect it will support Maltese growth, but as I said, we have not factored that in yet, and the benefits will be felt from 2020-22 onwards. Now, one of the factors that explained the positive trajectory of the Maltese rating prior to the pandemic was the track record with the public finances. Good track record of fiscal prudence and the resulting low government debt levels. The low level of government debt afford the Maltese authorities ample room to respond to the shock. This is our view. Malta has reduced its debt level by almost 30% between 2011 and 2019. That is a remarkable achievement, particularly relative to other Eurozone peers. So that's something that has it builds some resilience into the Maltese rating. And I want to conclude with a snapshot on because I've talked for too long, probably just a snapshot of the rating sensitivities for the Maltese rating, and that's mostly for your reference. We have another review this year on the 4th of December. Of the Maltese rating. I just want to say a word on the third positive rating sensitivity on the left-hand side of this slide. Further progress in addressing key weaknesses in governance, banking supervisions, and the business environment. The main message I would like to give is that if there is a deterioration in governance, it's something that matters. This is not specifically for Malta, in general for our for all the countries in our portfolio. Deterioration in governance is important within the context of a Fitch sovereign rating assessment. Structural features carry the heaviest weight in our rating criteria. And in this respect, the recent decision by the OECD Global Forum on Transparency and Exchange of Information for Tax Purposes, the decision to downgrade Malta's standing to partially compliant, is something that, that matters. It does not mean at all that it would lead to negative action, not at all. But it is something that we, given our rating methodology, the importance that we place on governance indicators, is something that we are keen to investigate and to understand more about in our discussions with the Maltese authorities and with the private people from the private sector as well. So I will probably conclude my presentation here because I've been talking for very long, and I'm quite keen to get any questions from the audience. But I thank you all for your attention for now. Thank you.
You are on mute, Vanessa.
Thank you very much, Michele. That was a very interesting, driving us through all the global outlook and down to the nitty-gritty of what I'm sure a lot of people would like to talk about. The first question is from John Caruana, who is a Central Bank of Malta employee. John, would you like to go ahead with your question?
Thank you very much for a very rich and interesting presentation. I have a question on the treatment of the NGEU. As you say, or as you said, you view it, if I understood you correctly, as ratings positive, especially for the lower rating sovereigns in Europe because of the introduction of an element of risk sharing. But of course, there is going to be debt now at the supranational level. So how would you assess the increase in debt that is in a sense novel? No, we've not really had this substantial volume of debt coming in at the European supranational level. Most of the debt has been contracted at national level so far. How would you assess the impact of the NGEU on fiscal sustainability at the supra level now? Thank you.
Yes, this is an excellent question. So let me just tell you first that for everyone's information, at Fitch we have a supranational team that works beside us that is responsible for the EU rating. So my team is not responsible for the EU rating. We obviously work very closely with them, but I will say a few words on how we view that. So because we have published a few comments on that, and we said that we think that the next generation EU is consistent with the AAA rating for the EU, and that is because that service is more than covered by potential additional contributions from the AAA member states. Now, what can change this? Assessment? Well, a downgrade of the AAA member states, for example, that could be something that changes the assessment, the AAA assessment on the EU. And maybe here I can say a few words. The AAA member states, the AAA EU member states, have their ratings were hit particularly during the Eurozone crisis. If you look at the performance, growth performance, public finance performance of the EU AAA countries relative to other AAAs since 2011, it's been a fairly strong performance. So they entered this, they are all on stable outlook, the AAAs in the EU, so there is no imminent pressure on their ratings. And we had actually just before the pandemic, one country, a AA+, Austria, on a positive outlook. So we will never know the counterfactual, but it would not be mad to think that without the pandemic, Austria could be a AAA now. So the pool of AAAs could increase. So no imminent pressure from this aspect, from the AAA rating aspect on the EU rating. Another aspect of your question could be whether next generation EU, given that it will create fiscal liabilities for the net contributor countries, I mean, will this be a negative rating factor for some of the AAA countries? We have commented on that publicly. We have said that at this stage, we do not see negative. I mean, it's true that we do not see that as a negative factor. Yes, next generation EU create new net fiscal liabilities for the net contributor countries. But number one, the repayment of the funds will happen will start late and will happen over a very long time frame. That's a first factor. Then a second factor, if next generation EU improves the resilience of the Eurozone, and as I said during my presentation, we think it can be an important improvement to the architecture of the Eurozone. Even the AAA rated countries, the net contributor countries, could benefit from this improvement in the institutional architecture of the Eurozone. So I hope this answer your partly at least your question.
Thank you very much for this clarification. Thank you.
And the next question, Michele, is from Malcolm Bray, who works with the Malta Fiscal Advisory Council. Malcolm.
So thank you very much for this very interesting presentation. Basically, at one point you were highlighting quite a lot the issue that you pay a lot of attention to the track record of the country, which I would presume that in the case of Malta, that is something which is seen therefore very favorably because of the long track record of strong growth and low unemployment rate. I was wondering whether you could shed some light on the extent of the economic model and the extent to which it could be vulnerable to possible permanent changes brought about by the pandemic, and maybe how that could feed into things like demand for commercial property, things like house prices. So basically the extent to which the future can be more uncertain than what we might possibly anticipate because of underlying structural changes brought about by the pandemic. Thank you.
Thank you. No, it's an excellent question, and I think not an easy one to answer. I mean, it is clearly a question that has sectoral implications. I mean, we are looking much more than we have ever done before at how this pandemic is impacting sectors, and it's very useful to look at how each sector is performing, to try and understand the pace of the recovery. Now, we talk a lot about with our corporate colleagues. We have a large corporate sector team. They clearly work on commercial real estate entities, to entertainment, tourism. So we gather really a lot of intelligence from them to inform our analysis. And I can try really and tell you that the main message that we get from them at this stage, it's number one, it's really very hard to gauge what are the concrete implications of social distancing. How will the social distancing is the key factor, I think. I mean, how social distancing will affect work, the life in the office, and the impact on commercial real estate. That's at this stage we qualify that as a potential downside risk to the, to all our forecasts, and then the tourism sector as well. I mean, part of the reason why we took actions, we decided to take action on countries like Malta, Portugal, Cyprus, Greece, was really, the reliance on the tourism sector. There is a lot of uncertainty about the outlook for the tourism sector. We need to be honest and probably admit that we do not know how the tourism sector will really be impacted in the long term. At the moment, our corporate sector colleagues expect a significant spillovers even in 2020-21. So very weak recovery of the tourism sector across the board in Europe, even for 2020-21. So this is something that informs our growth projections and also our rating assessment. But at the moment, I would like to stress that we expect this to be temporary. So we expect this impact on tourism sector and maybe on other aspects on the commercial real estate as well to be temporary. So to impact 2020-21 and maybe to a lesser extent 2020-22. But if this would turn out to be more permanent beyond 2021, 2020-22, then we would be looking at a significant change yes, in the economic model, probably not only of Malta, but also of other countries, and the implication for tourism sectors, commercial real estate, even the residential real estate and the dynamic, particularly in countries like the UK, city versus countryside. It's clearly something that is on our radar, but at the moment, we are still in the phase of studying it, and we consider the risk more of a temporary risk. If the implications will be permanent, it's something that can have a longer lasting impact on growth projections, on potential growth, and on our ratings as well.
Thank you very much. The next question is from the Central Bank of Malta librarian, Emmanuel Kakia. Emmanuel?
Good afternoon to you. Thanks for your presentation. I just am curious about how come you did not mention the US elections. I mean, they are quite on the horizon, and I'm sure that, I mean, either it's Donald Trump is going to win hands down, or I mean, it has not been taken into factor. The second question is about the new generation EU funds. I mean, I'm no economist, but from what I read in newspapers and etc., there is an agreement how many funds will be, given to the countries, but there's no so far an agreement how the EU is going to raise the funds. I mean, there is no agreement about a digital tax or financial sector tax. So how do you reconcile the two? Thank you.
Yeah. Okay, maybe I'll take it on the US. I think it's a fair point. Maybe my defense is that I've been talking for 47 minutes, and I think it was my presentation was focused on Europe really. So that's why I didn't mention the US. But you are absolutely right. I mean, most of the slides in the first part were actually on the US. What I can say there is that we have revised the outlook on the US. The US is a AAA with us, but we have revised the outlook to negative. I don't know if other rating agencies have done that so far. And the main reason, without going into details, is that there is just we believe there is no tangible plan to deal with this. With the increase, with the deterioration in the public finances over Trump re-election. I must say I had a look at the program of Donald Trump. The economic program is extremely short. There is not much in it. So in the event of a Donald Trump re-election, probably we would. I mean, the risk of further deterioration in the public finances would persist, and that would present some further downside risk to the rating. But even in the event of a Joe Biden win, the political focus is clearly not public finances, is not fiscal consolidation. Public debt is just not a consideration in the US political agenda at the moment, and that's something that matters for us and that we will have to consider in our rating assessment. Clearly, the US dollar is the world reserve currency, and that's something that affords the country quite a lot of flexibility, and that's part of the reason why also the rating is so high, despite the track record of public finances that is not among the best, particularly if compared with other AAA countries. So maybe I will say that on Trump versus Biden. So the tax collection at EU levels, how do we square that? I'm not sure I fully understood the question. I can say that, I mean, if your question is whether, the ability of the EU to generate its own resources, how we see that, well, we see that as important because it is a further, if there will be new taxation at EU level, we think that's a sign of a further integration and a sign that the monetary, it should something that it's a additional step towards a fiscal union. and that should be something positive that improves the resilience of the Eurozone over time. From going back also to the EU rating, what could it mean for the EU rating? We think that new taxes dedicated to the EU, I mean channeled to the earmarked to the EU, would be evidence of higher financial commitments by member states. So this would highlight quite a strong propensity to provide resources to the EU and support the AAA rating of the EU. So maybe I would say that. I'm not sure if I fully answer your question.
Yes, I think so. Thanks. Thank you so much.
Thank you very much, Michele. We have another question from Josef Kutayar. That's from the stockbroking firm Rizzo Farrugia. Josef, over to you.
Hello, Michele, and thank you for the presentation, and thank you for the Central Bank for this opportunity. I have two questions, and the first one is, what probability do you attribute to the possibility in your model, to the possibility of Malta being grey listed by the FATF, and the repercussion on this could have on Malta's rating from your end? And the second question is, maybe you can add a little bit more comment of how Malta could be impacted by a hard Brexit. I mean, and how could this impact your forecast going forward? Thank you.
Yeah. Okay. Thanks a lot for the two questions. So on the first question, there is no specific probability that we attach. As you know, these are sensitive matters, and we are careful in attaching probabilities to these things. We do try to understand the situation on the ground, and when the fact happens, I mean, if there will be a further deterioration of Malta's listing, then we will take that into account. What can be the implications? As I said, there are really two aspects here. One is the governance aspect. Governance is important in our rating criteria, and the World Bank governance indicators enter directly our sovereign rating model. So if such events were to result in a deterioration in the score of Malta in the World Bank governance rankings, that is actually something that has a very direct impact on our sovereign rating model score. So in this respect, there can be a negative impact on the rating. Then the second aspect is a bit more qualitative. So does this impact the reputation on Malta worldwide with investors, and does this impact the prospect for foreign investments in Malta? And that in turn could affect growth prospects for Malta and have an impact on the rating over time. So I think there are these two aspects that we would need to take into account when we look at the impact on Malta rating. Second question, impact of hard Brexit on Malta. Look, I have to be honest. It is really difficult to really gauge and fully understand what will be the full implications of UK and EU trading on WTO terms. It's even difficult to think about it, right? To be completely honest with you, think about the UK and EU trading on WTO terms. But Malta, I mean, you're right. We did a study some time ago highlighting which countries were most at risk from Brexit, and Malta was one of those that came out as most exposed. Not the most exposed in the EU, but in the pool of countries more exposed. Our sense, but as I say, this is really a sense from what we see on the ground, from discussions with authorities across the European Union and in the UK, our sense is that the EU has been planning for this, and the fact that there is also a Brexit contingency fund as part of the EU budget agreement is something that could mitigate the impact on some of the most affected countries, including Malta. So I think it is very hard really to assess at this stage what will be the direct impact. And let me also say that although we have moved our baseline to a hard Brexit effectively, in reality that does not mean that there will not be any deal. I mean, this is also one of those things where we have to wait and see how things will pan out until the last minute. We were here before, in a way. Last year also, the UK and the EU were on the verge of a breakdown in talks. So then there was a turnaround. Now, to be fair, things look more difficult, but there is still some chance that I mean, the sides are still talking to each other, basically. So there could be, I mean, despite recent developments in the UK politics, so that there could be, I would not rule out completely, despite our move to the baseline, that there might be a deal before December.
If I can just add a little question of my own, Michele, I see that you've got obviously the timetable of formal reviews, but given the volatility of the situation, how is the frequency of your ratings being affected?
Yes, it's a very good question. We did take quite a few rating actions out of calendar, we call them, back in April, between April and May. So Malta was one of those. Italy was also one of those countries. So to answer your question, the calendar has been affected. We thought we had to react, but we did that by using the framework that I highlighted. So countries that entered the crisis on a negative outlook, clearly they had much less rating headroom than others. And clearly we made the decision to review, to at least take a look at all the countries on positive outlooks. And Malta was a country on positive outlook, given the drastic change in the economic outlook. Since May, we have not taken in Europe any other out of calendar rating action. So I must stress that our aim is really to stick to the calendar. That's really what we want to do, and we consider out of calendar rating action really as exceptional events. So since May, we haven't had a single out of calendar rating action in Europe.
Thank you very much. We have another question. We still have another few minutes to go. Giovanni Bertolotta, if you'd like to introduce yourself. Sorry, I'm not from APS Bank. Thank you.
From APS Bank, yes, I'm the CRO here. Michele, thank you for the presentation. I just wanted to make a comment on the shape of the recovery. You presented as the most plausible option the swoosh, the Nike wing. I guess the V is out, the U is out as well, but there are, I think, other options still there. For example, a W, if we have a very strong second wave, there will be another contraction and then a recovery, maybe around half of the next year. And there is one that is, for me, fascinating, is the K-shaped recovery, where you have a part of the economy which recovers fast, and another part, the low-income earners, the people who cannot work from home because of the sectors where they work, which will eventually probably never recover. I don't know what is your view on the K.
Yeah, it's a good question. Well, I will not attach a probability to the K, but I would just say that it's clearly potential scenario. So the way we would see that is the one implication is obviously one question that we should ask ourselves, I think, as a rating agency, but as analysts, is if a K recovery was to materialize, if it would be sustainable over time, because there could be significant social implications, very significant social implications. You know, in our ratings, as I say, I've spoken a lot about the public finances, but we never said publicly, because it would have been wrong, we never said publicly that the policy response was wrong. In fact, we thought that we think that the policy response of individual governments was the right one. Because yes, when you impose lockdowns and you have a large part of the population that cannot work because of a policy decision, governments need to step in. So there is a fiscal cost, but there is a strong justification for that fiscal cost to avoid social implications, labor market implications that could have significant impact on the public finances down the line on potential growth. So if that K recovery was to become the baseline, I think number one, we would probably need to reassess quite significantly with our economics team our potential growth forecast. There could be a significant impact on potential growth, and that is something that could affect our public debt sensitivity analysis, longer term debt sensitivity analysis as well. On top of that, as I say, the social aspect, something very difficult to capture in sovereign ratings, but it's something that it could affect ratings. I mean, if there were significant social implications, what would be the implication for the politics in individual countries, and also implications at maybe a wider EU level. So it's definitely a scenario, a downside scenario relative to ours, which could have some rating implications, I would say, but I'm not going to attach probabilities to it. Sorry.
Okay, grazie.
Thank you, Giovanni. We have a question from Sandro De Marco, our Deputy Governor.
Hello, Michele. Yes, it's me again.
Yep.
I just wanted to ask one question. Is there concern at Fitch from the increase in the sovereign bank nexus in Europe that is, of course, is arising as a result of the pandemic?
Yes, I would say it's not a new concern. We've been concerned about the sovereign bank nexus even before the pandemic. It's something that our banking sector team highlights in their commentaries, and something that we've been highlighting specifically in countries where the sovereign bank nexus is quite strong. So yes, there is concern, and I didn't mention in my presentation the contingent liabilities aspect and the NPL, so I focused on the labor market. But what I said about the labor market could apply also to asset quality in a way. I mean, at the moment we are seeing credit to the private sector picking up. We are not seeing any increase in non-performing loans, but the big question mark is yes, what happens next? I mean, when these support schemes in the job subsidy schemes will phase out, and also maybe liquidity support to SMEs will start to be unwound, will this result in an increase in NPLs, and will this move into the sovereign balance sheet via the call of the guarantees that have been granted? I must say that we try to be very conservative, almost for every country where large program of loan guarantees have been put in place. We assume that quite a chunk of these guarantees is called in 2020-21. So in our fiscal numbers, we try to be quite conservative there. But yeah, it is something that is on our radar. It was a concern before the pandemic, and yes, I think the pandemic is probably enhancing this concern.
Thank you.
So, Michele, I think it's time to let you go. Thank you so much for being with us today. Can I also thank, of course, Brian Micallef and Aaron Grech from the Economics Department, who put all of this together, and obviously the governors for their support. And to those who are following this lecture, please follow us on LinkedIn and on Facebook. We have Central Bank of Malta events where we publicize these kind of events which may be of interest to you. We will, of course, let you know the next time we have something planned. So I think that's all from us for today. Thank you very much and keep safe, as we say nowadays. Goodbye.
Yeah. Thanks a lot, everyone. Bye. Have a good day.
Thank you, Michele. Bye.
Bye.